Felix here, and welcome to this slightly echoey, no more, live stream Fed interest rate decision in 28 minutes, followed by the press conference, which is the much more interesting bit, because we pretty much already know, well, at least we think we know, that it's going to be a 0.75% interest rate hike. 27 minutes and 40 seconds, says Bloomberg here on my screen. And we're going to take the opportunity to take some questions up front, talk about the expectations, and of course have a glance at the market, and also Goldman's top 17 stocks. Have you downloaded them yet? It's completely free. felixfriends.org/top17, felixfriends.org/top17. It's a benchmark. It's a beauty. I made it just for you. Yes, I really did. Now the following is financial advice. You know that by now. Here we go. You can see my options portfolio. There we go. Market is roaring and bright in green. Why? Because earnings are all coming in less horrible than expected. Very simple. But in about 26 minutes, the Fed could turn all of that around. How? Well, they could make the price of orange juice go up further. No, not really. That's not really what this is about. What this is actually about is how tough will the language be going forward? Are they going to give us some hints and there'll be questions? You know, will you do another 0.75% interest rate hike in September? What are you seeing for November, December, and so on? And that's what we're looking for here. What's Winston up to? He was lying under my feet. Oh no, he's moved around the corner. But no, he's having a nice day. He's chewed a 4-month-old puppy this morning, and then he spent an hour or two in the forest with his friends, getting up to no good and rolling around in something particularly smelly, judging by the stench that emanates from him, but he likes it that way. So I haven't watched the creature in about a year. Let me have a look at where we are on the market. PayPal absolutely flying, which is brilliant for me because it used to be my biggest position. It no longer is, because it decimated itself. It basically sold itself off. I didn't have to do much. And Google is flying. Chinese education stocks flying. That makes no sense. Meta up 5.5%. Nvidia up 5%. Microsoft up almost 5%. Coin up almost 5%. That's what happens when ARK sells your shares. Tesla up to $809. Netflix up. I mean, everything up. Amazon up. This is like one of those golden days. I feel like it's 2020. It's sort of a back to the future here this morning. Palantir up to 965. That's nice. Even SoFi is up. Literally every single thing on my watch list is up. Is it everything? No. There are a few suffering. Mullen, okay. Visa is getting a little bit pummeled. I'm not sure it's particularly fair. MasterCard also in sympathy. Pfizer is down a touch. Should have set up a Pfizer trade, actually. Barber down a little bit. Neo down just a smitherin. And Polestar just flat, which is generally how that stock seems to be at present. So what does it all mean? Well, it's the exuberance before the hammer hits. That's what happened the last 2 times, I think. I think we definitely had the same sort of thing in the morning of the last rate hike. And then he came in with pretty tough language. And what happened? The market went woohoo. And then the day after, the market read the newspapers and the transcript, and they thought, oh, that really was pretty ugly, wasn't it? So let's turn it around. That's basically what we were seeing last time. Is it going to be the same today? Well, it really depends on the language he's using. That's really the key thing here. It's not about the size of the rate hike at all, but we also have some other fairly big news. Chip makers are getting $52 billion. That's a big win for Biden, one of the first wins I can remember. Good news for chip stocks. Are chip stocks flying? Are they? Let's have a look. Do we have INTC on our list, for example? No. Do we have AMD on our list? AMD's up 3%. Let's have a look at Intel as well. So what does that mean? It basically means the US government is going to subsidize, encourage, incentivize big chip companies to set up, major factories in the US. Intel up 1.76%, pretty muted response there to that, not particularly enormous. Let's have a look at the bond market here this morning, see how our yield curve inversions are going. 3 months, it's at 249. The 2-year is at 3. Okay, that's not a conversion. What about the 3 years at 299? 10 years at 276. Okay, 2 year is also, so that's the classic inversion. The 2 year is higher than the 10 year, which makes no sense because if you lend somebody money for a longer period of time, you know, the 2 year is also higher than the 30 year. Crikey. People are really expecting some upheaval here in the next year or so. The 1 year is higher than the 30 year, which is pretty staggering stuff. So what does that mean? Recession. And I mean, obviously, you know, Jerome Powell is a reasonably intelligent man. It's probably a very intelligent man. He can read these indices too. And he will also look at that and go, looks like we're causing a recession here this morning. Is that really what we want? Is that really what we're trying to achieve? Well, it isn't really, but it's a byproduct of what he's doing. So he kind of can't help himself, basically, but cause a recession. Yeah, let's have a look at what's the dollar doing. The dollar is up just moderately. I mean, of course, higher interest rates mean more people put their money into dollars, right? Very, very simple. So you would think that have a positive correlation. Crude oil is up. Gas is unexpectedly down. Not really quite sure. Oh yeah, that's the China story. China isn't spot buying any natural gas, any LNG, which is unusual for this time of the year. And you can only think that they are digging up enough coal or something so that they think that they don't need it, or maybe the weather is particularly mild at present, so they don't need it. So that's perhaps going on there. Kraft reporting disappointing earnings. Double-digit price increases eroded demand for their product. Volume fell 3.3%, and yeah, they're struggling with inflation. I was trying to set up a Kraft Heinz trade earlier today, and it would have been bearish, but I couldn't find any volume, so I didn't. But do you want to see how much money we are making? You want to see it? I just posted it on YouTube. If you want to see, hang on. Can't see a thing, can you? Here we go. If you go to our little community section, there are also pictures of Winston. You can see just, so yesterday, we took $322 in profits on the McDonald's and the GE trade. And I posted the screenshots here for you so you can see it. People are whinging sometimes and saying, I don't know if this is real. How do I know this is real? Well, you can open the pictures and you can see that they really are real. And then today, so far, $530 profit taken on UPS, Microsoft, and Visa options trades. Took me 3 minutes to close those. I do them on my phone now, and I spent about another quarter of an hour setting up 6 new trades, all 80% probability trades. This is a screenshot of my this there might have need to resize these so people can see them better. Okay, it comes out better in Twitter for some reason. At least I thought it did. Maybe I probably need to get better at this posting business, hey? Where is it? Here we are. We're live. Yay. Oh, yeah, see, Twitter does it a bit more nicely. You can actually see the whole thing. So you can see when we get to like 87, 90%, 95% of max profit, I just take the profit, UPS as well, and then we basically bank them. And then you can see a bunch of other trades I set up today, which are all looking golden and rosy and green. I mean, that MasterCard trade's already at 78% of max profit. So we could literally take that today and we'd be making $170 in the space of about 1 hour. Probably let it run a little bit more because there's no real urgency to do anything with that. You know where you can learn that. I put a link down below if you want to join our free options program and get a feel for it. There's about 10 real lectures in there, really like proper insight. It gives you a good grounding. Also some lessons on using brokerages, which is probably the most confusing part of the whole thing of learning to trade options. Hugely profitable though. Gas prices are apparently falling in the US. Are they? Where are you guys based in the US? Can you tell me? All right, let me have a look at the comments here. Did I miss anything? Good news for chip companies, bad news for US taxpayers. Well, it's always bad news for US taxpayers when the government does something, isn't it? CHIPS Act has gone through indeed. We're going into the moon, really. Good afternoon. Robert says they're real, the trades. Robert's one of my coaching students, so thank you very much, Robert, for confirming that. You are starting real money trading. Is it next week? I guess are we having a chat tomorrow? I haven't seen it in my diary yet. If you haven't put it in yet, Robert, do. Have you ever considered cash secured puts instead of credit spread? Seems like a profitable way to get along if you want shares at a certain price. Yes, absolutely. If you want to acquire a particular share, 100 particular shares of any company, then selling put options is a good things to do, as long as you've got the cash to actually buy them. So your intention has to be to buy that. Otherwise, your risk is pretty significant. You wouldn't want to be assigned 100 shares or something you don't want. So here we go. 17 minutes, 24 seconds is the countdown to the FOMC meeting. And yeah, so puts, terrible strategy for trading, cash secured puts, but good strategy for acquiring stocks cheaper if you have a little bit of time and you don't mind getting some money in the meantime. So absolutely. Derek, so all the platforms will ask you some questions about what your experience is. So what we do is we start with paper trading. So you can literally sign up to Thinkorswim, no, absolutely bugger all, and they'll immediately give you a paper trading account, and then you can practice, and it looks and acts exactly the same way. You don't need to know anything, and you gain your experience that way. Once you have the experience, you then apply to Webull or Thinkorswim or Tastyworks or any of the other brokerages out there that are half decent, and you can then show them, hey, look, I know what I'm talking about. And when they ask you these silly questions, you will know what they mean. So they do it allegedly to protect people, which is sort of fair enough. But yeah, so if that's your hurdle, it's kind of a chicken and egg scenario, isn't it? How do you ever learn if you don't know? If you can't practice? Well, you can practice with paper trading. If you're North America, get yourself a Thinkorswim paper trading account. Just apply, put your name in, done, and you can log in straight away. You don't even need to provide them with ID checks or anything else like that. My pleasure, Derek, always. Bloodnort, Tastyworks, yeah, Tastyworks much more user-friendly than Interactive Brokers. So if you're not in North America, you basically have to use Interactive Brokers to practice, unfortunately. And it's just a platform that's a little tedious. But we've got lessons on that. We've got videos on that. Also in the free options program down below, there are actually videos specifically on how to use Interactive Brokers, because I know it's a bit of a pain point for everybody. So there we go. Do you use paper trade account for your options or cash? So I have cash in my account. Why do I run a double account? Because it's a really bad idea to live stream your real account. You'll inevitably have a problem. So I basically run the same trades. I do them twice. It's not very time consuming. It takes maybe an extra 30 seconds a trade or something. So that's why I always show you my paper trading account. Here it is. So that my account number and stuff like that, and my usernames, etc. If people watch them, and they are tricky people out there. So it's better not to do that. Don't live stream or screenshot even your real accounts. I think it's a really bad move. But look at that. Look at these trades. Didn't I set all of these up today? I think I set all of these up today. All of these except for the NXPI trade I set up today. So I've already taken profits. How much did we take earlier today? Took $530 this morning, like an hour ago, and we've already got another $440 we could take right now. So I won't yet. There's no real urgency for these, but see, that's just lovely, isn't it? So we're going to make about $1,000 today here. Earnings season is like, it's like a festive season in my house. We celebrate every single moment of it. It's just good fun, hugely enjoyable. So we've got about 13 minutes here till the FOMC rate decision. As soon as we have that out, I will, of course, share it with you. And then the real excitement will be the press release just half an hour later, because that's really what we're all about here. We don't particularly care what the rate decision is. Well, we all know, I think it's going to be 0.75%. So unless it's different, the market isn't going to react to that. But the language used to hit us over the head with going forward is really important. The free options trading link says it's expired. Seriously? Hang on. felixfriends.org/free options. Let me just check it out. Testing. Seems to work for me. Does anybody else have a problem with that link? Derek, you're very kind. Okay, seriously, if you've got a problem with that link, it says it's expired. You mean on the Teachable platform, it says it's expired? Okay, let me just test that out. I wouldn't want to give you guys a link that doesn't work. That's highly irritating. Okay, let me just use a test. Test the count. Just testing a password here. 1, 2, 3, 4, 5, 6, 7, 8, 9. That's not a real password. I just want to see whether this link works or not. Yeah, it does. No, it does work. It works for me. Give it another shot, or maybe just hit refresh or something. Okay, I'd appreciate you asking. Mark, you logged in $655 this week with my options. Brilliant. Very proud of you for keeping dedicated and studying. What's your opinion for interest rates this time? 0.75%. I don't think we're going to get that surprise 1% move. Why? Because we've had some economic data in now that isn't particularly exuberant and amazing, and I think therefore they are going to go a little bit easy on us here. Semiconductors, well, I don't actually own any. I think it's usually a very capital-intensive sector with a lot of technology that I don't understand. That's really the simple reason. And now we've got politics in it. So I don't really like things with politics in it. It's just too complicated, too unpredictable. So I'm not particularly interested, Cherry, but I appreciate the question. Surprise 0.5, says Oleg. I also don't think so. I think that would show a weakness on the side of the Fed, and we haven't had, look at our inflation data that we've got. It's pretty significant. If you look at, can we look at previous week? Just look at the US for a second here. Just look at the important stuff. Previous month. Why is China still on there? How did China manage to sneak onto there? Where is it? Core inflation rate 9.1%. You don't raise the inflation rate less than expected when you have a 9.1% inflation rate. It's just not the done thing. So no, I don't think that's what's going to happen here. But we do have some data that gives us some indication of a slightly weakening US economy. And so I think there are going to be at 0.75. I don't think they're going to go nuts. We've got GDP growth rate data coming in. It's fair to expect that the Fed would have seen that data and they would know that it's coming in, forecast is 0.6%. It's sort of going to likely be around the zero mark, I would have thought. Economists are usually right. Ivan, welcome. I appreciate you being back. Ivan, also one of my coaching students. Welcome to the live chat. I'm glad you are back in civilization. He was in Florida, I think. So. Yux from Discord wants a reply. All right, I'll have a look after the live. Any thoughts on gold? I have a little bit as a total hedge, like literally if civilization collapses, but I don't really see it as an investment for me. It's more of a, if the lights go out, I could go and barter for bread. That's more the way I look at that. And recession tomorrow, quite possibly. Are we ready for the market to move up? Well, the market has moved up. I mean, crikey, look at that, right? 2.7% up on the NASDAQ, 1.3% on the S&P. We saw a very, very similar story before the last Fed interest rate decision, and which is, by the way, in 7 minutes. And, what happened afterwards? Everyone's like, that was good news. And I was like, no, it really wasn't. And the day after, the market tanked. So let's see if that happens again. Airbus just announcing they're cutting the delivery goals, ramping up production of its best-selling narrow-body models, supply chain issues, and so on. World's largest plane maker expects to hand over 700 aircrafts this year. They're expecting 720. So we're getting these moderate disappointments, but they're all moderate. None of them are like, oh my God, how terrible is this, right? We are looking at my portfolio, my options portfolio, and we're hopefully going to make just over $1,000 today, which is very nice for literally 18 minutes spent on it today. And probably another 10 minutes just sitting back and admiring it. But that wasn't really hard work. So we could take profits on these, but we shan't, because there's more money to be had there. I shared that with you guys also on Twitter and so on. So there's a link, by the way, to a free options program down below if you want to really get started with that. There's a lot of information there, 10 real lessons on my premium program, and also a lot of information on how you get your brokerages set up, which is super, super important. Have they changed the definition of a recession? Well, they're sort of muddling with it. Look, a recession is traditionally 2 consecutive quarters of falling GDP. But the only country in the world that doesn't stick to it, it's not Togo or Tonga or, somewhere, some sort of far-flung island in the Pacific. But there's one country in the world that doesn't stick to that rule, and that has a bunch of old gray men who sit around a circular table. I imagine it's circular, and they decided at their discretion, and that country is the United States. So your recessions happen because somebody says it happens, not because of data. So they will probably argue that it's because of large imports, because of restocking, that there is this technical recession when it isn't really a real recession, which of course is a little nonsense. But you know it, I know it, but there we go. Uganda found 30 million tons of gold. I knew I'd lost something. Brilliant. I'm very glad for Uganda. I hope that will enrich the populace at large, and it'll be a wealthy, transparent, and stable country. But I fear a civil war is coming. Unfortunately, it seems to be what's happening around there. Thomas, what's your criteria when you take profits on an options contract and when you let it expire? Okay, first of all, you have to take into account the market you're in. So in a calm market where your VIX is 15 or something, you just let it expire. You just take the profits, save yourself a few bucks on trading fees. In a market as nutty as this one, I generally speaking take it when it goes to sort of 80, 90%. And also bear in mind just your likelihood, like how has your trade changed? So I set up this MasterCard trade about an hour ago, and it's trading now at 340. My break even is 367. So it can go up like 8-9%. So there isn't really any urgency for me to do anything here, right? That's the way I set it up. Now, if it was sort of over here and it was showing some profit, I might just take it, because it's much, much more likely to kind of, stray into the red money losing zone. So there is, of course, a little bit more of a technical thing in there. If you talk to my head coach, he'll say to you, well, if you're in the loss-making area, I generally look for a negative delta of 40 to pull the trigger or something like that. And that's fine. And that's what we of course, teach rules-based trading. For me, honestly, I started with the rules, and it eventually gets replaced a little bit by experience. So I sort of look at the trade and kind of deal with it. I'm much, much more aggressive. I aim to be at least with losses, get out of them very, very quickly. So our friend here who's spamming us, I'm going to get rid of him. Would you like the black background on trading view better? No, can't see it. Can't see the charts. I don't know why. My eyesight can't handle it for some reason. So I'm one of those people. Andrea, your G or E option isn't closing. That can happen. Yes, can happen. But it's probably looking quite healthy, isn't it? Do you think finding all that gold will make the price of gold go down? Well, has it? Let's have a look at where's gold. Gold has gone up a little bit today. Yeah, Gold's a funny one, isn't it, really? It's a funny investment. I know there are entire channels and people who feel very, very dedicated to it. I'm not one of those people. I'm not against it either. I'm broadly for investing a bit in everything. I think diversification is a wonderful thing. VIX, by the way, is down 4% today. So the market is just expecting everything to be glorious and predictable, and the Fed to say, yes, we raised 0.75% today, but we won't do that to you again. We know you can't handle it in the autumn, so we will be more generous and kind and gentle. And we think we're going to get this lovely soft landing. The economy is slowing, unemployment is rising, and everything will be great. That's basically what the market wants to hear. Are we going to hear that in about 2 minutes? I very much doubt it, but it's possible. Everything is possible. We're going to have a look at, I always look at the Federal Reserve's press releases, and I'm always disappointed because Bloomberg always gets them before their own press officer, it seems. They never uploaded there first. So we are probably going to have to hit the refresh button in 2 minutes on Bloomberg to get the news first. I don't really know why. Maybe Michael Bloomberg rings him up or he gets a fax or something. T-3 for the Fed, indeed, less than 2 minutes. Press the like button, says Robert. That's one way to make sure the market's going to stay up, guys. Hit that like button, see what's happening to the market in the future as those earnings numbers are out. We're going to have a look at a nice, juicy QQQ chart as well as that announces. And bear in mind that for all of the last announcements, it's taken the market usually a good 24 hours to really get to grips with this information. That the initial reaction is typically kind of nonsense. So here's the market, minute by minute. 2 o'clock will be here. I can get rid of the Fibonacci lines, so it's a little less confusing. And let's see what we get here. Volatility is going up. You can see that going towards the 2 o'clock, right? Which is exactly what you'd expect, you lovely options traders out there. And will the stock market go up? The stock market won't really react to the interest rate if it's what we expect. And it's what we expect is 0.75%. It's about the guidance going forward, which we get about half an hour later. We should do a group meet somewhere in the Hamptons. Absolutely. I'm with you on that. The Hamptons are lovely. And that's where everybody goes, it seems, in August. I was in Frankfurt yesterday. I wanted to take pictures of bankers in the wild. There were quite a lot of them. You can identify them at the identical uniform that they all wear. All right, guys, it's imminent. Literally, we should have a countdown here. A couple of seconds left for that interest rate hike to come in, screaming and kicking, and then we'll get the, you know what we'll be getting. We'll get the press release, and then we'll get the actual press conference straight after, which is exactly what we're here for, which is going to be much, much more exciting. So hang on to the edge of your seat. Make sure your knuckles are nice and white, or just relax and chill. Breaking news. And 75 basis points, unanimous vote is in. That is precisely what we expected. Here we go, and they put it out first. For release at 2 p.m. Recent indicators of spending and production have softened. The market's going to love that. Nonetheless, job gains have been robust. The market's going to hate that in recent months, and the unemployment rate has remained low. The market is not going to like that statement. Inflation remains elevated, reflecting supply and demand imbalances related to the pandemic, higher food and energy prices, and broader price pressures. Russia's war against Ukraine is causing tremendous human and economic hardship. The war and related events are creating additional upward pressure on inflation. The market's not going to like that, and are weighing on global economic activity. The committee is highly attentive to inflation risks. Highly attentive. That's an interesting phrasing here. That's sort of a neutral statement. The committee seeks to achieve maximum employment and inflation rate of 2% over the longer run. Okay, we know that. In support of these goals, the committee decided to raise target range of the federal funds rate to 2.25% to 2.5%, and anticipates that ongoing increases in the target range will be appropriate. That's the same language as last time. That's Good. In addition, the committee will continue reducing its holding of treasury securities and agency debt and agency mortgage-backed securities as described in the plans reducing the size of the balance sheet that we issued in May. That's also good news. No changes there. The committee is strongly committed to returning inflation to its 2% objective. I'd say that's also good news because that's the same sentence we heard last time. In assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming information for the economic outlook. The committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. You could read that both ways, right? They're kind of saying, yeah, we could be more aggressive, but I would say the market's going to read this as we could soften if the economy slows down. The committee's assessment will take into account a wide range of information, including readings on public health. They're worried about whatever, the latest monkeypox or whatever it is. That's a good statement. We quite like that because that's a concern that might make them be a little bit more cautious. Labor market conditions, inflation pressures, inflation expectations. That's going to be the big one to watch, by the way, inflation expectations and financial international developments. Voting for the policy action where everybody. So is that good news? Well, I color-coded this in case you hadn't noticed. I like to do things like a 6-year-old. Yep. Winston is the same. Spending and production have softened. That's a really good statement. Let's see what the QQQ does here. You see? The green, can you see just by the color coding how much the green outweighs the red? And the QQQ actually for once seems to be going in the right direction here. Volatility spiking very, very nicely too. This is a minute-by-minute chart, so it all looks a little bit more dramatic than it is in real life. Yeah, it is 0.75%, guys. It is basically as expected. The statement is, I'd say it's a little bit softer than I thought it might be, but really the proof will be in the J. Powell live pudding, which is out in just under 25 minutes. That's really what sways the market, because this is kind of well and good, but he's going to get asked questions by all the big news agencies, and they're going to ask him things, and he's going to have to give answers that go beyond this very, very generic statement here that we always get. But the language, there's nothing in here that's kind of new and more hawkish. Yeah, really there isn't. Unemployment remained low. Job gains have been robust. I mean, this is what they hate. But they did acknowledge that spending and production have softened. That's the first time they have acknowledged that. And that's, in my view, why the market is spiking up a little bit, although it's coming back down. There's just a touch here. But we're now almost 3% up on the NASDAQ. Absolutely insane stuff here today. Let's have a look at the SPX as well at the same time. Let's also have a look on a minute chart there, see what the reaction is in sort of the real world economy, and 1.5% up. So this was, where was 2 o'clock? 2 o'clock was there. I don't know, it's a bit unfair, isn't it? I made this one so big, it looks so different. So let's move that under here roughly too. Let me put in the 2 o'clock up there too, so you can see it. So there we go. That's 2 o'clock on S&P down below and QQQ up above. So actually, the reaction is now muted from the initial kind of jump. The dollar index spot is just dropped a little bit to 0.1%, which is a touch of a drop, but not a massive reaction because it's basically as we expected. So why are we here? Why do we care? Why are we watching this? Because we're about to get some genuine insight from Jerome Powell, the man himself. And the last two of these press releases, the market seemed to not understand what the heck he was saying for at least 24 hours. So I do think this actually gives us, for once, an informational advantage. Now QQQ dropping. So we're basically back to where we started at this point. So Andrea, good question. So he will read out a statement, and then there will be a approximately 20-minute or so Q&A with actual journalists in the room. So he spends a good half an hour with us usually, and it's quite quite insightful, and they're quite good questions because it's Reuters and Bloomberg and people with half a brain at least asking those questions. Actually, they are very intelligent journalists. Whereas when you get him talking to Congress or the Senate, it's just a bunch of politicians who want to talk as much as possible and make statements, which isn't particularly useful. So these questions are actually quite intelligent. Markets like it? Well, not so much now. It's coming down a little bit again. Let's have a quick look at what the big boys react to it. Let's see who's typing quicker. Flags, weakening economic data. Exactly, that's what we are saying. The market should like that. At least the QQQ should like that. The S&P is a bit more arguable. 75 basis points to double down on inflation. Stocks climb after Fed raises rate. Powell. Okay, let's have a quick look if they add anything to what we just said. Steepest increase since Paul Volcker. Yeah, there we go. If you throw Paul Volcker around enough, the market will eventually tank. Investors are now to see the Fed slows pace in September. Precisely, that's what we're basically looking for. And that's the indication that we are hoping to get here today in the next, literally in about 20 minutes. Are they going to give us some hint that if things continue to slow down, they might slow us a bit? So we basically got what we were expecting. Now, if we go to September, so we got to 2.25 to 2.5 percentage point. For September, we were expecting yesterday hang on, let me just double check. So 2.5%. We were expecting a 0.5 percentage point interest rate hike, 50%, and 41% of people were expecting another 0.75%. So it'd be interesting to watch this data in another hour or so, because this is based on Fed futures. So it's not a poll or something idiotic. It actually gives you some data. So the market is broadly speaking split between 0.5 point rise and a 0.75% rise for hike for September. So this data is going to give us some indication of how the market perceives what Jay Powell says shortly. And yeah, I don't think it changes that quickly. It does change, but not that dramatically. So at the moment, it looks like we might be going more for a 0.5 percentage point rate in September, which would be a good thing for the market. I mean, that would be a potential turnaround for us. The market created a little bit erratically, and now it's kind of climbing its way back out of the hole. It's just dug for no particular reason. And it's MIBA is a great question. Why does the QQQ like it, and why shouldn't the S&P like it? So QQQ is a bunch of tech stocks, right? A lot of them the big ones obviously are profitable, but a lot of them, we kind of value them more on future earnings, much more in the future than if we say we look at AT&T or something, which is in the S&P. And therefore, we use discounted cash flow models to look at like how much money are they going to make in 5 years and in 10 years. And then we work backwards how much that 10-year profit is going to be worth in today's money. And the higher the interest rate, the bigger the discount to work backwards what the future profits are worth in today's money. So basically a 1% interest rate hike shaves about 9% off a proper growth company that isn't making profits yet. And that's partially why we've seen such a decline in the market here. Jason says, puts on Meta, very, very risky play, what you're doing there. I did this trade on Meta. Do you want to see it? Bullish trade on Meta, but it's a trading at 167. It can fall all the way to 142. So it's a massive drop, right? 12, 13% drop. And I still make $250, which is about, I don't know, how much is this? How much money did I need for this trade? Yeah, 10% return by Friday. So what I've done is I've limited my risk. My max risk is limited, is capped. I basically bought a hedge put to make sure that I don't get this unlimited risk that you have if you're doing puts. Plus, because I'm selling options, I get 4% more money than you do. By buying options, you're paying 4% too much. So unfortunately, people who buy options get you're starting off 4% in minus. Where's the market heading? Well, everybody would, of course, love to know that. My view on this is that I think we need to go into a proper recession, and that'll probably be Q4 when they actually admit it. Although possibly after November, electioneering and all that. And at some point, the jobs data is going to get worse. Economic data is going to get suddenly worse. And the Fed will start to slow down to 0.25% interest rate hikes. And then possibly in Q1, we might find ourselves into a worse and worse economic situation, and they turn this ship around and they stop shredding money and all of that. And I think at that point, or just before that point, the market's going to rebound. But don't try to time this stuff. There's really no point. There's really no advantage. Just keep buying great stocks at cheap prices. And in the meantime, enjoy this volatility. I mean, how often do we get this level of volatility, 24.7 for months and months and months, which is just marvelously profitable. I did 6 new trades today. I closed out 3. We're going to make about $1,000 today, up 28% so far just this month, 127% since the beginning of the year. And it's just fun. It's just beautiful. It's profitable. It's just absolutely enjoyable. And yeah, our profit P&L for the day so far is $1,000. And how much money have we got invested? 18,000. So it's not too shabby, is it, for a day? That's a pretty good return. What's 1,000 over 18? 1 over 18. So we're so far making about 6% in a day. And we're doing that, not that same amount every day, because I'm always distracted and so on. But it's a very, very profitable way of making money if you know the way to do it. But the whole leap thing and covered calls and buying puts and all of this is unfortunately not something that your kind of Wall Street options traders would ever contemplate, because it isn't particularly profitable. There are better trades out there. No, it's not terrible, but there are, the leaps are terrible. Buying calls is pretty terrible. But, like the covered call thing, for example, I actually got a question on that today. Someone said, why do you hate it so much? I don't hate it. I just think that there is a much, much better way out there to make a lot more money with a much, much higher probability without capping your profits. What would be the least favorable market environment to trade options in? If you've got super, super low volatility, in a sense, yeah, your trades are not making as much money as quickly. But you also have to bear in mind that the market isn't moving. So you just set up all these strangles, straddles, and so on, and you still make quite a bit of money. And really, you make money in all environments. At the moment, yes, we make more money, but it's also a little bit more, it definitely requires a little bit more attention just because the market moves so crazily. So yeah, in this, reasonably high volatility, I guess my ideal volatility would probably be 20, something like that. I'd be very happy at 20 or 15. That would be sort of the sweet spot. But when it drops below that, we still make a lot of money, and we might even start to buy the occasional option. But we're still going to do it on a market neutral basis. So we don't ever do this one directional nonsense. Hike as expected, says Christoph. Indeed, if you guys just joined us, a quick recap here on the press release from the Fed just issued out. And then in 15 minutes, we're getting to CJ Powell do his press conference, which is really where the money's at today. So he said recent indicators of spending and productions have softened. That's good for the market because he's acknowledging for the first time that the economy is actually slowing down. Cheers. And job gains have been robust. Unemployment has remained low. He obviously doesn't like that. And then we got the war sentence. We also kind of knew that. And then they say that the committee is highly attentive to inflation risks. That's no change. No change in language there, which is good. And the committee will continue to reduce its treasury holdings because that's all already known. That's why I highlighted that in green, because there's really no change here. But maybe we should make that orange because there's really no change here. And then the committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. Lovely language. You could flip that on both sides and say, well, that could be a hawkish statement. But I think the way I read that, I think that the risks are more on the downside for the economy here. So I think overall, it's a pretty neutral statement in this kind of hawkish Fed environment. But interest rates have just gone up by 1.5% in the last 2 months. That's the first time that's happened since Volcker. So they are being hawkish, but we are hoping that they are going to become more soft in their hawkishness as we head into September. They are going to go to the beach. They're going to lie in beautiful mansions along the coastline of the Hamptons. They're going to be sipping champagne and nibbling on oysters and all that sort of thing, having their feet massaged while they glance into the distance, and they're going to come back softer, happier, more fulfilled, and they'll be thinking, oh, let's not be so harsh on all those people with jobs. That's sort of what the market's hoping for, right? Basically, that's what we're going to hope for. So the market's kind of did this rather rational little bounce here, and the QQQ came down again for no particular reason, and now it's coming back up again as those people who put their drinks down realized that was a load of nonsense. Let's take the profits. S&P likewise. I would expect the S&P not to react quite as happily to this as the QQQ, because that's what's been hit much, much harder. But so far, QQQ is up 2.8 percentage points just today. We look at the stocks broadly. Anything suffering here that wasn't suffering? Visa is down 2.6%, and yet we're making money on. Oh no, we already made the money on Visa. We closed the trade earlier today, and Pfizer is down a little bit. We got a trade on Pfizer open, don't we? We do. Where is it? Here it is. It's a bullish trade, but Pfizer's going down 1.1%. Does it matter? Not really. It could literally go down all the way to $48, which seems a little far-fetched at present. Verizon's down a touch, MasterCard down a touch, but not a lot. And then Baba, Xpeng, and so on, pretty flat. And really flying today is PayPal. It's that new investor they've got. And he's basically promising us cuts, expenditure, cost cuts, job cuts, undoubtedly. And we as cold-hearted, cold-blooded investors love it. Get rid of some people, improve my profits. It's all very 1980s, isn't it, around here? Roblox also flying. I know somebody who's got a lot of Roblox stocks. That'll make him very happy. Coin is recovering. Meta is up 5%. Nvidia up 5%. Microsoft up 5%. Tesla up almost 5% at 813. Netflix up 4%. Amazon up 3%. It's just one of those days. AMD up 3.3%. That would also be helped by this chip bill just being passed today. A big win for Biden also, I think, on that front. A sensible decision? Yup, I think it is. I think it's probably the one thing that everybody can agree on, that onshoring chip manufacturing is a good idea. Derek, yeah, I love that, absolutely. Bankers in the Hamptons, better call Netflix. Indeed, wouldn't that be fun? Wouldn't you like to be a fly on the wall in that? I think you have to set it in the 80s to make it more fun, because I worked at an investment bank, I shan't say which, but you know the one, for a little while. And those guys were living a little bit like the 80s were still around, but they were the dinosaurs. They were the last ones, I think. Jay Birchtree said Sony had some volatility spike. Good for 2 to 0 day trades. Well spotted, Jay Birchtree. I should gladly have a look. If we get negative GDP tomorrow, do you expect the market to tank? No, the opposite, Robert. I would think the tech market, your kind of QQQ, would love that, because it would imply that the Fed might need to do less because demand is really tanking. But if it's one of those technical things where it's all about imports, then it might not have much of an impact. What would fall is probably your kind of real world stocks, your sort of Walmart where like real people go, not the sort of Netflix type thing. Or Google or something. I would think that they would be rather unaffected by this. NEO delisting. Well, Gensler came out today with more strong language. I think he said he seems very, very frustrated by his negotiations with the Chinese side. I think they're not giving in easily. They're not known for that. They are very, very good negotiators. So I would expect that to continue for some time, and the US side to get rather frustrated, to be honest with you. I think that's the way that's going to go. Hopefully, I mean, I think it's in everybody's interests to, agree. I think there really is absolutely nobody who would benefit from the not coming to an agreement. I'm just going to slow down my speech here as I toggle on the screen sharing for the Fed. Where did it go? Here we go. There we go. That was beautiful, wasn't it? Almost. Hang on. There we go. There we go. So we've got a little bit of time until those guys kick off, but I'll just ping it in the corner for now. Where did I go? I'm missing one Felix. There he is, peeking around the corner. I wish I could pop myself into the black area. That would be much more space efficient, but I can't. I sort of have to kind of hover here on the edges. If you just joined us and you are interested in making money to fill your pension pots, your college funds, your second house in the Hamptons fund, whatever it might be, go to felixfriends.org/free options. It's a beautiful free program course, about 10, 12 lectures in there, including how to actually get started, how to set up your brokerages and everything else. So check it out at felixfriends.org/free options and learn how we make money over here. And we are making a lot of it. And it's fun. It's really, really exciting. We made 28% so far this month. 127% since the beginning of the year. And just today, we've taken $530 in profit so far. I can show you the portfolio. We're at $1,040 so far today. And that's on $18,000 US. So we're up at almost 6% just on the day. And that's the beauty of options, and that's the beauty of earnings season. Earnings season is it's like Christmas, really. Christmas can happen 4 times a year, plus you get the real Christmas thrown in. Who wouldn't want that? I certainly do. So check it out down below. Right, Leo, let me see if I missed any questions here. Elevator waiting music. Oh, I'm sorry about that. I'll mute it. I haven't got it yet. What happened to my music? Okay, cool. Okay, great. Okay, I had elevator music and Bloomberg in my ear at the same time. That's quite a lot of information to absorb. Can I be using music? Man, says Robert. Stefan, what happens if your stocks get delisted? Well, likely, if they are listed in, say, Hong Kong or Singapore or somewhere like that, you could convert at a fee. I think we asked Charles Schwab about a year ago, and I think they were charging $35, something like that. Each broker is a little bit different. If your brokerage doesn't have access to, say, the Hong Kong Stock Exchange, it becomes a little bit trickier. You'd have to open Webull or something like that, or Moomoo or something, one of those that, everybody's throwing those affiliate codes about all the time. Just go into any other channel. We don't do that around here. And then you could transfer it out. Now, if you only own 3 shares, it's probably not worth doing. You better just sell the thing. If you own a lot more, then it might be worth doing. But what would genuinely happen, of course, is that demand gets slashed, right? Very significantly, because US investors would be largely out. So that's not a good thing. What is the music selector for the conference? Cringe. Yeah, it's not marvelous, is it? It's pretty bad, actually. Sandra, do you have rules when you close a running trade? Yeah, we have rules. You can look at delta. That's a good thing to look at. You can also just set yourself a predetermined rule. Say, if it's double my credit or something like that, then I get out. It's definitely good to establish rules and principles, and we do that. It can be a little bit personal, and it obviously depends on your portfolio size and diversification and so on. So the key thing is always to actually set it up in a way that you're making money from the beginning, and not that you are, I'm just trying to see the best place to put myself. What do we think? I think for the moment, we don't need to see the Fed thing. Fed's going to be speaking in 3 minutes, so we'll be almost live here. So far, QQQ has taken it in its stride, up 2.9%. S&P is up 1.5%. So it's that purple line here, that vertical purple line is the 2 o'clock time frame. So let me see if I can get these on the same spot. That's when the Fed announced it. There should be a button to align multiple charts to the same time frame. There probably is. I just haven't found it yet. So you can see, broadly speaking, we were up. So put another. That's the baseline where we were. You can see we're above that red line, basically, right? So that's a good thing. And Robert said, yeah, Robert is my star mentee he does trading more seriously than everybody. He does like 50 trades a week, which is just marvelous. I mean, I've done 6 today, which I feel quite good about, which is why we're up $1,000 on the day. But yeah, Robert with 50 a week, crikey, you're going to make some serious money. Delta 45, get out, something like that. Yeah, 40 or so, you could get out there. It's a reasonable strategy to do. Beyond English and economics, do you speak any other languages? Well, if you're throwing economics in there, I used to be a lawyer, believe it or not. I know. And I'm German, so I do speak German. I live in the south of France. My French is pretty horrendous. It's sort of wanting to come back, but doing so with great big gaps. So my Spanish is also horrific. So there we are. Latin is probably slightly better than my French, but not very useful though. So there we go. The training link sent me to an expired webinar. Am I doing something wrong? Hang on. Let me have a quick look at that. Is that the link in the description, possibly? Okay, let me just find and fix the link for you guys. Okay. Yeah, apologies. That link down there is the wrong link. Thank you very much for telling me. Free options, saved, done. Okay, try it again. It'll work now, I promise. Okay, news conference. Here we go. Oh my God, we need sound. Oh, he isn't there yet. So what I'm going to do is I'm going to scribble a little bit on here so you get a little bit of context.
Good afternoon. My colleagues and I are strongly committed to bringing inflation back down, and we're moving expeditiously to do so. We have both the tools we need and the resolve it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2.5 years and have proved resilient. It is essential that we bring inflation down to our 2% goal if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight, and inflation is much too high. Against this backdrop, today the FOMC raised its policy interest rate by 0.75 percentage point and anticipates that ongoing increases in the target range for the federal funds rate will be appropriate. In addition, we are continuing the process of significantly reducing the size of our balance sheet. And I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. Recent indicators of spending and production have softened. Growth in consumer spending has slowed significantly, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened, in part reflecting higher mortgage rates. And after a strong increase in the first quarter, business fixed investment also looks to have declined in the second quarter. Despite these developments, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Over the past 3 months, employment rose by an average of 375,000 jobs per month, down from the average pace seen earlier in the year, but still robust. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, while labor supply remains subdued, with the labor force participation rate little changed since January. Overall, the continued strength of the labor market suggests that underlying aggregate demand remains solid. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in May, total PCE prices rose 6.3%, excluding the volatile food and energy categories. Core PCE prices rose 4.7%. In June, the 12-month change in the Consumer Price Index came in above expectations at 9.1%, and the change in the core CPI was 5.9%. Notwithstanding the recent slowdown in overall economic activity, aggregate demand appears to remain strong. Supply constraints have been larger and longer lasting than anticipated, and price pressures are evident across a broad range of goods and services. Although prices for some commodities have turned down recently, the earlier surge in prices of crude oil and other commodities that resulted from Russia's war on Ukraine has boosted prices for gasoline and food, creating additional upward pressure on inflation. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 percentage point, bringing the target range to 2.25% to 2.5%. And we're continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and evolving outlook for the economy. Today's increase in the target range is the second 75 basis point increase in as many meetings. While another unusually large increase could be appropriate at our next meeting, that is a decision that will depend on the data we get between now and then. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. As the stance of monetary policy tightens further, it likely will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. Our overarching focus is using our tools to bring demand into better balance with supply in order to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty in what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks and determined to take the measures necessary to return inflation to our 2% longer run goal. This process is likely to involve a period of below trend economic growth and some softening in labor market conditions. But such outcomes are likely necessary to restore price stability and to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Hi, Chair Powell. Thanks for taking our questions. Rachel Siegel from the Washington Post. I'm wondering if you can walk us through your thinking around the decision not to go for a full percentage point increase. We saw a ramp up after the May CPI report came in hotter than usual, and then obviously the June figure did too. Was there any discussion of a stronger hike at this meeting? Yeah, thank you.
Sure. So we did judge that a 75 basis point increase was the right magnitude in light of the data and in the context of the ongoing increases in the policy rate that we've been making. I'd say that we wouldn't hesitate to make an even larger move than we did today if the committee were to conclude that were appropriate. That was not the case at this meeting. There was very broad support for the move that we made. You mentioned the June meeting. We had said many times that we were prepared to move more aggressively if inflation continued to disappoint. And that's why we did move to a more aggressive pace at the June meeting, as we said we would do. At this meeting, we continued at that more aggressive pace as inflation has continued to disappoint in the form of the June CPI reading.
Thank you so much for taking our questions. Colby Smith with the Financial Times. As the committee considers the policy path forward, how will it weigh the expected decline in headline inflation, which might come as a result of the drop in commodity prices, against the fact that we are likely to see some persistence in core readings in particular? And given that potential tension and signs of any kind of activity weakening here, how has the committee's thinking changed on how far into restrictive territory rates might need to go?
So I guess I'd start by saying we've been saying we would move expeditiously to get to the range of neutral. And I think we've done that now. We're at 225 to 2.5, and that's right in the range of what we think is neutral. So the question is, how are we thinking about the path forward? So one thing that hasn't changed is that it won't change is that our focus is going to continue to be on using our tools to bring demand back into better balance with supply in order to bring inflation back down. That'll continue to be our overarching focus. We also said that we expect ongoing rate hikes will be appropriate and that we'll make decisions meeting by meeting. So what are we going to be looking at? We'll be looking at the incoming data, as I mentioned, and that'll start with economic activity. Are we seeing the slowdown in economic activity that we think we need? And there's some evidence that we are at this time. Of course, we'll be looking at labor market conditions, and we'll be asking whether we see the alignment between supply and demand getting better, getting closer. Of course, we'll be looking closely at inflation. You mentioned headline and core. Our mandate is for headline. Of course, it's not for core, but we look at core because core is actually a better indicator of headline and of all inflation going forward. So we'll be looking at both, and we'll be looking at them at those both really for what they're saying about the outlook rather than just simply for what they say. But we'll be asking, do we see inflationary pressures declining? Do we see actual readings of inflation coming down? So in light of all that data, the question we'll be asking is whether the stance of policy we have is sufficiently restrictive to bring inflation back down to our 2% target. And it's also worth noting that these rate hikes have been large and they've come quickly, and it's likely that their full effect has not been felt by the economy. So there's probably some significant additional tightening in the pipeline. So where are we going with this? I think the committee broadly feels that we need to get policy to at least to a moderately restrictive level. And maybe the best data point for that would be what we wrote down in our SEP at the June meeting. So I think the median for the end of this year, the median would have been between 3.25 and 3.5. And then people wrote down 50 basis points higher than that for 2023. So that's, even though that's now 6 weeks old, I guess, that's the most recent reading. Of course, we'll update that reading at the September meeting in 8 weeks. So that's how we're thinking about it. As I mentioned, as it relates to September, I said that another unusually large increase could be appropriate, but that's not a decision we're making now. It's one that we'll make based on the data we see, and we're going to be making decisions meeting by meeting. We think it's time to just go to a meeting by meeting basis and not provide the kind of clear guidance that we had provided on the way to neutral.
Nick Timmeros of the Wall Street Journal. Chair Powell, you've said that your policy works through influencing expectations and that policy needs to be at least moderately restrictive, which means you need financial conditions to stay tight. Futures market pricing currently implies you will raise rates this year along the lines of your June SEP, but then lower them a few months later next year. Are these expectations consistent with the need to keep financial conditions tight in order to moderate purchasing power and bring inflation back to 2%?
So I'm going to start by pointing out that it's very hard to say with any confidence in normal times, what the economy is going to be doing in 6 or 12 months. And so to try to predict what the appropriate monetary policy response would be, I mean, of course, we do that in the SEP, but nonetheless, you've got to take any estimates of what rates will be next year with a grain of salt, because there's so much uncertainty. These are not normal times. There's significantly more uncertainty now about the path ahead than I think there ordinarily is, and ordinarily it's quite high. So again, I would, the only data point I have for you really is the June SEP, which I think is just the most recent thing that the committee's done. Since then, inflation has come in higher, economic activity has come in weaker than expected. But at the same time, I would say that's probably the best estimate of where the committee's thinking is still, which is that we would get to a moderately restrictive level by the end of this year, by which I mean somewhere between 3 and 3.5%, and that the committee sees further rate increases in 2023. As I mentioned, we'll update that, of course, at the September meeting, but that's really the best I can do on that.
You said inflation had been a little bit hotter than anticipated. Has your view of the terminal rate changed since June?
So I wouldn't say it was. I think we didn't expect a good reading, but this one was even worse than expected, I would say. I don't talk about my own personal estimate of what the terminal rate would be. I will write down that it's going to evolve. It's obviously it has evolved over the course. I think for all participants, it has evolved over the course of the year as we learn how persistent inflation is going to be. And by the time of the September meeting, we will have seen 2 more CPI readings and 2 more labor market readings, and significant amount of readings about economic activity and perhaps geopolitical developments. Who knows? It'll be a lot. It's an 8-week intermeeting period, so I think we'll see quite a lot of data, and we'll make our decision at that meeting based on that data.
Gina. Hi, Jerome. Thanks for taking our question. Gina Smilik, New York Times. You kind of alluded to this earlier, but I wonder, in the event that you see several months of very weak headline inflation numbers because oil prices are coming down so much, but core inflation continues to be strong or even picks up, I wonder how you would think about that.
So it's hard to deal with hypotheticals, but I just would say this: we would look at both, and we'd be asking ourselves, are we confident that inflation is on a path down to 2%? That's really the question. And we'll be making, our policy stance will be set at a level ultimately at which we are confident that inflation is going to be moving down to 2%. So it would depend on a lot of things. Of course, as I mentioned, core inflation is a better predictor of inflation going forward. headline inflation tends to be volatile. So in ordinary times, you look through volatile moves in commodities. The problem with the current situation is that if you have a sustained period of supply shocks, those can actually start to undermine or to work on de-anchoring inflation expectations. The public doesn't distinguish between core and headline inflation in their thinking. So it's something we have to take into consideration in our policymaking, even though our tools don't really work on the some aspects of this, which are the supply side issues.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. Earlier this week, the president said we are not going to be in a recession. So I have two questions off of that. Do you share the president's confidence in not being in a recession? And second, how would or would not a recession change policy? Is it a bright line, sir, where contraction of the economy would be a turning point in policy, or is there some amount of contraction of the economy the committee would be willing to abide in its effort to reduce inflation?
So as I mentioned, we think it's necessary to have growth slow down, and growth is going to be slowing down this year for a couple of reasons. One of which is that you're coming off of the very high growth of the reopening year of 2021. You're also seeing tighter monetary policy, and you should see some slowing. We actually think we need a period of growth below potential in order to create some slack so that the supply side can catch up. We also think that there will be, in all likelihood, some softening in labor market conditions, and those are things that we expect and we think that they're probably necessary if we were to have to get inflation, if we were to be able to get inflation back down on the path to 2%, ultimately get there.
The question was whether you see a recession coming and how that might or might not change policy. Thanks.
So we're going to be focused on getting inflation back down, and we, as I've said on other occasions, price stability is really the bedrock of the economy, and nothing works in the economy without price stability. We can't have a strong labor market without price stability for an extended period of time. We all want to get back to the kind of labor market we had before the pandemic, where differences between racial and gender differences and that kind of thing were at historic minimums, where participation was high, where inflation was low. We want to get back to that, but that's not happening. That's not going to happen without restoring price stability. So that's something we see as something that we simply must do, and we think that we don't see it as a trade-off with the employment mandate. We see it as a way to facilitate the sustained achievement of the employment mandate in the longer term.
Howard Schneider with Reuters. Particularly in regard to expectations, it's been said the last few months that the risks of doing too little outweighed the risks of doing too much. Does that remain the bias?
So we're trying to do just the right amount, right? We're not trying to have a recession, and we don't think we have to. We think that there's a path for us to be able to bring inflation down while sustaining a strong labor market, as I mentioned, along with, in all likelihood, some softening in labor market conditions. So that's what we're trying to achieve, and we continue to think that there's a path to that. We know that the path has clearly narrowed, really based on events that are outside of our control, and it may narrow further. So, I do think, as I said just now, that restoring price stability is just something that we have to do. There isn't an option to fail to do that, because that is the thing that enables you to have a strong labor market over time. Without restoring price stability, you won't be able to, over the medium and longer term, to actually have a sustained period of very strong labor market conditions. So, of course, we serve both sides of the dual mandate, but we actually see them as well aligned on this.
As a follow-on to that, given the uncertainty and the sort of paradoxical flow of data you've been getting, if you're going to make a mistake, would you rather make the mistake on doing too much, raising too much, than raising too little?
Yeah, we're trying not to make a mistake. Let me put it this way. We do see that there are two-sided risks. There would be the risk of doing too much and imposing more of a downturn on the economy than was necessary. But the risk of doing too little and leaving the economy with this entrenched inflation, it only raises the cost. If you fail to deal with it in the near term, it only raises the cost of dealing with it later. To the extent people start to see it as just part of their economic lives, they start to factor high inflation into their decisions. When that, on a sustained basis, when that starts to really happen, and we don't think that's happened yet, but when that starts to happen, it just gets that much harder and the pain will be that much greater. So I really do think that it's important that we address this now and get it done.
Thanks, Chair Powell. Neil Irwin from Axios. To build a little bit on what Steve was asking, do you believe the United States is currently in a recession? Will the GDP reading tomorrow affect that judgment one way or the other? And has your assessment of the risk of recession changed any in recent weeks?
So I do not think the U.S. is currently in a recession. And the reason is there are just too many areas of the economy that are performing, too well. And of course, I would point to the labor market in particular. As I mentioned, it's true that growth is slowing, and for reasons that we understand. Really, the growth was extraordinarily high last year, 5.5%. We would have expected growth to slow. There's also more slowing going on now. But if you look at the labor market, you've got growth. I think payroll jobs averaging 450,000 per month. That's a remarkably strong level for this state of affairs. The unemployment rate at near a 50-year low at 3.6%. All of the wage measures that we track are running very strong. So this is a very strong labor market, and it's just not consistent with 2.7 million people hired in the first half of the year. It doesn't make sense that the economy would be in recession with this kind of thing happening. So I don't think the U.S. economy is in recession right now. Haven't seen it, and we'll just have to see what it says. I don't. I would say generally the GDP numbers do have a tendency to be revised pretty significantly. It's very hard. It's very hard to accumulate U.S. GDP. It's a large economy, and a lot of work and judgment goes into that. But you tend to take first GDP reports, I think, with a grain of salt. But of course, it's something we'll be looking at.
Hi, Chair Powell. Victoria Guida with Politico. I wanted to ask about the new conflict of interest rules that you all rolled out. Some senators have written asking for those rules to have more teeth and to have sort of more transparency about the Fed officials' financial activity. I was wondering if you could speak to that and whether you intend on toughening those rules in any way.
So those are the toughest rules in place, at any comparable institution that I'm aware of. We think, we thought about this carefully, and we put them in place, and we're building the infrastructure so that the enforcement will be tight, that actually you won't be able to make trades unless they're pre-cleared. And the amount of trades you make will be, they'll have to be 45 days or more before any FOMC meeting. It's just, I think we've really, created a very strong and robust set of rules that will, support public trust in the institution. And again, we're just now, the system is just now up and running, and I'm proud of what we did.
Hi, Katerina Saraiva, Bloomberg News. I wanted to ask a little bit more about the 75 basis points versus 50 versus 25. Can you talk a little bit about what kind of goes into your thinking for, making the decision on how much to raise rates? And, just talking about a very large amount that you alluded to, could that possibly be 100 basis points? And then kind of along those lines, is there any sort of weakness in the economy outside of inflation measures that would lead you to slow your hiking pace?
So I'm gonna take that as a question about the next meeting and thereafter. So as I mentioned, we're going to be looking at all of those things: activity, labor market, inflation, and we're going to be thinking about our policy stance and where does it really need to be. And I also mentioned that as this process, now that we're at neutral, as the process goes on, at some point, it will be appropriate to slow down. And we haven't made a decision when that point is, but intuitively that makes sense, right? We've been front end loading these very large rate increases. Now we're getting closer to where we need to be. So that's how we're thinking about it. And we're, you know, in terms of September, we're going to watch the data and the evolving outlook very carefully and factor in everything and make a decision in September about what to do. And I'm not really going to provide any specific guidance about what that might be. So, you know, but I mentioned that we might do another unusually large rate increase, but that's not a decision that we've made at all. So we are, you know, we're going to be guided by the data. And I think you can still think of the destination as broadly in line with the June SEP, because it's only 6 weeks old, and sometimes SEPs can get old really quick. I think in this one I would say is probably the best guide we have as to where the committee thinks it needs to get at the end of the year and then into next year. So I would point you to that.
Hi, thank you. Chris Rugaber at Associated Press. I wanted to ask about, right now there's a sort of growing gap between the Fed's preferred measure of inflation, the PCE index, and the one that's followed by the public, the CPI, of course. How do you expect to handle this divergence if the PCE starts to come down enough for you to consider slowing rate hikes, even if the public is still seeing much higher CPI ratings? Thank you.
So it's an interesting situation. Of course, we've long used PCE because we think it's just better at capturing the inflation that people actually face in their lives. And I think that view is pretty widely understood. That said, the public really reads about CPI. And the difference really is because the CPI has higher weights on things like food, gasoline, motor vehicles, and housing than the PCE index does. And so that accounts for a lot of the difference. However, over time, they tend to come together. You know, we were given the importance in the public eye of CPI. We are calling it out and noticing it and everything like that. But remember, we do target PCE. That is because we think it's a better measure. They will come together eventually. The typical gap was really about 25 basis points for a very long time. And if it got to, you know, 40 basis points, that would be very noticeable. Now it's much larger than that because of the things I mentioned. So we'll be watching both, but again, the one that we think is the best measure always has been PCE, at least since I think we, some 20 plus years ago, moved to PCE.
I'd like to weave a couple of things together, Mr. Chairman. Michael McKee from Bloomberg TV and Radio. You said that the destination pretty much remains the same in terms of your end of the year target, but where are you in the journey? We've now seen the federal stimulus programs end. You mentioned consumer spending, business investment have slowed. Are they moving at a pace you would expect, or is demand still greater than supply, too much greater than supply, that you need to do significantly more? And I ask because there are lags in the impact of monetary policy, as you mentioned, and a lot of this might hit in 2023. The strong dollar effect may hit in 2023 when the economy might be weak. How do you know where you are and where you think you need to get to?
Well, just talking about demand for a second, as I mentioned in my remarks, I think you pretty clearly do see a slowing now in demand in the second quarter. Consumer spending, business fixed investment, housing, places like that. I think, you know, people widely looked at the first quarter numbers and thought they didn't make sense and might have been misleading in terms of the overall direction of the economy. Not true of the second quarter, but at the same time, you have this labor market. So there are plenty of experiences where GDP has been reported as weak and the labor market is strong and the economy has gone right through that and been fine. So that's happened many times. And it used to happen, if you remember, in the first quarter of every year for several years in a row, GDP was negative and the labor market was moving along just fine. And it turned out to just be measurement error. It was called residual seasonality. We don't know the situation. The truth is, we think that demand is moderating. We do. How much is it moderating? We're not sure. We're going to have to watch the data carefully. There is a great deal of money on people's balance sheets that they can spend. The unemployment rate is very low. The labor market's very hot. There are many, many job openings. Wages are high. So it's the kind of thing where you think that the economy should actually be doing pretty well in the second half of the year. But we'll have to see. We don't know that because you do see a marked slowing in the second quarter. that is fairly broad. So we'll be watching that. We'll be watching that. Of course, as I mentioned, we do want to see demand running below potential for a sustained period to create slack and give inflation a chance to come down.
Hi, thank you, Chairman. Nicole Goodkind, CNN Business. When does the committee expect to see a meaningful slowdown in the labor market, and how much weakness will it accept with regard to slower job growth and higher unemployment before it pauses or begins to think about cutting rates?
So I think you're already seeing, you've seen in the labor market, what you've seen is a decline from very high levels of job creation last year and earlier this year to modestly slower job creation. Still quite robust, as I mentioned. So you're seeing that. You're seeing some increase in initial claims for insurance, although that may actually have to do with seasonal adjustments. We're not sure that that's actually real. There's some evidence that wages, if you look at average hourly earnings, they appear to be moderating. Not so yet from the other wage measures, and we'll be getting the Employment Compensation Index measurement, I think, on Friday, I guess. And that's a very important one because it adjusts for composition. So I'd say you and also anecdotally, you hear much, the sort of level of concern on the part of businesses that they simply can't find workers is probably down a little bit from what it was, say, for example, late in the latter parts of last year. So there's a feeling that the labor market is moving back into balance. If you look at job openings or quits, you see them moving sideways or perhaps a little bit down. But it's only the beginning of an adjustment. But I think most also, if you look at, I mean, once you start citing these things, you can't stop. If you look at the household survey, you see much lower job creation, and the household survey can be quite volatile, but it has no jobs created in the last 3 months. So that might be a signal that job creation is actually a little bit slower than we're seeing in the establishment survey. So executive summary, I would say there's some evidence that labor demand may be slowing a bit. Labor supply, not so much. We have been disappointed that labor force participation really hasn't moved up since January. That may be related to yet another big wave of COVID, and there's evidence that that's the case. But so we're not seeing much in the way of labor supply. Nonetheless, I would say some progress on demand and supply getting back in alignment.
Before you think about pausing?
So I think we're going to be looking at inflation as well. We you know, as I mentioned, we need to see inflation coming down. We need to be confident that inflation is going to get back down to mandate consistent levels. That's not something we can avoid doing. That really needs to happen. And we do think, though, that the labor market can adjust because of the huge overhang of job openings, of excess demand, really. There should be able to be an adjustment that would have perhaps lower than expected increases in unemployment, lower than would be expected in the ordinary course of events, because the ratio of vacancies to unemployed is just out of keeping with historical experience, and that suggests that this time could be different.
Thanks, Mr. Chairman. Edward Lawrence from Fox Business. So you said the path may be narrowed to avoiding a recession. So how close are we to a recession? And then how to forecast the possible recessions from banks and economists? How does that make a soft landing you've talked about more difficult?
So as I mentioned, it doesn't seem that the U.S. economy is in recession right now. And I think you do see weakening, some slowdown, let's put it that way, in growth, and you see it across some of the categories that I mentioned, but there's also just the very strong data coming out of the labor market still. So overall, you would say that in all probability, demand is still strong, and the economy is still on track to continue to grow this year. But the slowdown in the second quarter is notable, and we're going to be watching that carefully. Sorry, what was a lot?
Forecasts. How do bank forecasts of possible recessions, economists? Does that affect the soft landing?
Well, we've said since the beginning, I think, that having a soft landing is what we're aiming for. Of course, that has to be our goal. It is our goal, and we'll keep trying to achieve it. I do think events at the beginning, we said it was not going to be easy. It was going to be quite challenging to do that. It's unusual. It's an unusual event. It's not a typical event given where we are. If there is a path to it, and we think there is, it is the one I mentioned, that the labor market actually has such a large amount of surplus demand that you could see that demand coming down in a way that didn't translate into a big increase in unemployment as you would expect in the ordinary course, because frankly the imbalance is so much greater. But we don't know that. I mean, this is a case of first impression. So anyone who is really sure that it's impossible or really sure that it will happen is probably underestimating the level of uncertainty. And so I would certainly say it's an uncertain thing. Nonetheless, it's our goal to achieve it, and we'll keep trying to do that.
Thank you, Mr. Chairman. Jean Young with Market News. I wanted to ask about the balance sheet reduction program. It's been working for a couple months now and in a different environment than the last time the Fed did it. What are you learning about how it's working and how markets are reacting? And is reaching the minimum level of reserves needed in the system still several years away at the current pace?
So we think it's working fine. As you know, we tapered up into it, and in September we'll go to a full strength, and the markets seem to have accepted it. By all assessments, the markets should be able to absorb this, and we expect that'll be the case. So I would say the plan is broadly on track. It's a little bit slow to get going because some of these trades don't settle until for a bit of time, but it'll be picking up steam. So, and I guess your second question was getting, the process of getting back down to the new equilibrium will take a while, and that time it's hard to be precise, but the model would suggest that it could be between 2.5 years, that kind of thing. And this is a much faster pace than the last time. Balance sheet's much bigger than it was, but we looked at this carefully, and we thought that this was a sensible pace, and we have no reason to think it's not.
Hi, Chairman Powell. Brian Chung, Yahoo Finance. Looking at financial conditions, it seems like the tightening has slowed as of late, with the 10-year coming down, 30-year fixed mortgage rates also going a bit sideways when we talk about a hot housing market still. Just wondering if you find financial conditions tight enough, especially as you continue to raise rates.
So a big piece of that is inflation expectations, break-evens coming down, which, is a good thing. It's a good thing that markets do seem to have confidence in the committee's commitment to getting inflation back down to 2%. So we like to see market-based, readings of inflation expectations come down. Broader financial conditions have tightened a good bit. I mean, the way this works is we set our policy, and financial conditions react, and then financial conditions are what affects the economy. So, and we don't control that second step. We're just going to do what we think needs to be done. We're going to get our policy rate to a level where we're confident that inflation will be moving back down to 2%. Confident. So that's how we're going to take it. And of course, we'll be watching financial conditions to see that they are appropriately tight and that they're having the effect that we would hope they're having, which is to see demand moderate and inflationary pressures recede and ultimately inflation come down.
Thank you, Chair Powell. Greg Robb from MarketWatch. I wonder if you can go back a little bit in time to before there was this outbreak of inflation, when the committee put in place forward guidance on tapering asset purchases. I think it was December 2020. There's a recent speech by Fed Governor Waller talking about that and saying that maybe that was too tight, that kind of condition, and it put you a little bit behind. Not his words, but maybe, we're kind of late to react to some of that inflation. So could you talk about that decision, and have you looked at it in hindsight at all? Thank you.
So, yeah, we said that we wouldn't lift off until we had basically achieved our dual mandate goals. And the reason we did it in real time was that the first look at the new framework that we'd rolled out, plenty of people were saying, oh, it's not credible, you'll never get inflation to 2%. Some of our critics now who say inflation is too high were the same ones who were saying you'll never get to 2%. Well, but anyway, that's what happened. So we thought we needed to really make a strong statement with that. It wasn't part of the framework. The December 20 guidance was not part of our overall new framework. It was just guidance that we put in place. So I would say two things. One, I don't think that is materially changed the situation, but I have to admit, I don't think I would do that again. I don't think I would do that again. Ultimately the situation evolved in a highly unexpected way for all of us. And, maybe the learning is that leave a little more flexibility than that. But did it matter in the end? If you look at, I really don't think it did. I'm not sure it would have mattered if we'd been raising rates 3 months earlier. Does anybody think that would have made a big difference? I mean, lots of central banks were raising rates 3 months earlier, and it didn't matter. I mean, this is a global phenomenon that's happening now. Admittedly, different in the United States, but anyway.
Just a lot of people talk about that time, and they talk about a taper tantrum that I know you haven't talked about it too much, but that you were worried at the time about repeating that taper tantrum that you had experienced as a governor. So was that part of that? Where did that fit into all this? Thank you.
So I think we learned there have been multiple taper tantrums, right? So there was the famous one in 2013. There's what happened at the December 18 meeting where markets can ignore developments around the balance sheet for years on end and then suddenly react very sharply. So we just had developed a practice of moving predictably and doing it in steps and things like that. It was just like, that's how we did it. And so we did it that way this time. We were careful to take steps and communicate and all that kind of thing. We were trying to avoid a tantrum because they can be quite destructive. They can tighten financial conditions and knock the economy off kilter. And when it happens, you have to really, in both 13 and 18, really had consequences for the real economy, 2, 3, 4 months later. So we were trying to avoid that. That was part of it. Again, I don't think that's the real issue of 2020 and 21 was just trying to understand what was happening with the reopening economy. That was where the big uncertainty was. And our view was that these supply side issues would get better, that people would go back to work, that labor force participation would come back, everyone would get vaccinated, schools would open, kids would be in school, and labor force participation would jump back up. That was very broadly thought to be the case. These supply side issues would get solved reasonably quickly, and they just haven't. They still haven't. So that's really the learning, I think, is around how complicated these supply side issues can be. We haven't seen this before in a long, long time. And so that's really what accounts for the pace at which we moved. And, we did, when inflation changed direction really in October, we've moved quickly since then. I think people would agree. But before then, inflation was coming down month by month. And, we kind of thought we had the story, probably had the story right. But then I think in October, you started to see a range of data that said, no, this is a much stronger economy and a much higher inflation than we've been thinking. And again, we pivoted and here we are.
Nancy Marshall-Genzer with Marketplace. Chair Powell, I just want to pin you down a little bit more on the issue of recession. So if we get a negative GDP number tomorrow for the second quarter, would the Fed consider the U.S. in a recession? And just remind us, what is your definition for the start of a recession?
So the Fed doesn't make a judgment on that. We're focused on the dual mandate and using our tools to achieve maximum employment and price stability. We don't say there is now a recession, that kind of thing. So that wouldn't be something we do. We would look at the data tomorrow, and no doubt we'll look at it very carefully and draw whatever implications we can. As I mentioned, though, if you think about what a recession really is, it's a broad-based decline across many industries that that's sustained for more than a couple of months, and there are a bunch of specific tests in it, and it just doesn't seem like that now. What we have right now doesn't seem like that, and the real reason is that the labor market is just sending such a signal of economic strength that it makes you really question the GDP data. But again, that's not a decision that we make, and we won't reach a conclusion one way or another on that.
Thank you very much. Simon Rabinovich with The Economist. You've said that some softening in the labor market is needed. Within the Fed, there are staff economists who've argued that NIRU, the non-inflationary rate of unemployment, might be as high as 5 to 6% right now, which obviously is a lot higher than the current rate of 3.6. What's your assessment of NIRU? Is that something that came up in discussion with the committee?
So I think broadly, a lot of economists think that the natural rate of unemployment will have moved up to some significant extent above where we think it was before. And the reason is it's the usual matching issue where matching has become less effective and that kind of thing when you have the kind of turbulent downturn and the big switches in demand from services to goods and all that. So it could be higher, and my own instinct is that the natural rate of unemployment is higher. Of course, I would add that we don't know it. We can never know where these star variables are in real time with any confidence, but I would say it must have moved up materially. But the other side of that is as all these jobs get created and people go back to work and unemployment is so low, I think you could, in principle, you could see it coming back down pretty significantly. And that would also, by the way, take pressure off of inflation, because it's that gap. It's the gap between actual unemployment and the natural rate that really is relevant for, the negative slack we have in the economy by the overtight labor market. So if you were to, you wouldn't observe this. It's an unobservable, but you could actually be seeing inflationary pressures coming down if that does happen. And we don't control that, but that's something that logically, if the pandemic and the disorder in the labor market cause the natural rate to move up, then as the labor market settles down, in principle, you should see it move back down.
Thank you, Chair Powell. Jeff Cox from CNBC.com. Just a question about, hate to keep banging the drum about recession, but most of the polls that we're seeing now from the public, people believe that we're already in a recession or heading for one. Economists, pretty much the same thing. They're being told by folks like you and in the administration that we're not in a recession, we're not heading for a recession. Frankly, coming from the same people who told them that inflation was transitory, telling them now that we're not heading for a recession. So what would you tell the public to reassure them now that you feel confident in your forecast going forward and the Fed is ready to respond to a potential downturn in the economy?
No, all I've really said is I don't think it's likely that the U.S. economy is in a recession now. And I've explained why that is the case. It's because you do see a very strong labor market, and I think the public will see that as well. Going forward, what we've seen is a slowing in spending, as I mentioned. We've seen the very beginnings of perhaps a slight lessening in the tightness of the labor market, but it would only be the beginnings. So, and I mentioned that I also said that our goal is to bring inflation down and have a so-called soft landing, by which I mean a landing that doesn't require a significant increase, a really significant increase in unemployment. We're trying to achieve that. I've said on many occasions that we understand that's going to be quite challenging and that it's gotten more challenging over recent months.
Thanks, Chair Powell. Kyle Campbell with American Banker. The FOMC has historically tried to avoid the kind of rapid monetary policy tightening that has happened so far this year. How concerned are you that the rate hikes that we've seen thus far might increase risks to financial stability, not just domestically, but globally?
There are precedents for the FOMC moving very quickly. For example, 1994, 1980, even more so. So we've been known to do that when it's the appropriate thing to do, and this year it clearly is. I would say that given how quickly we've moved, I'm gratified that that basically markets have been working, they've been orderly. There's been some volatility, but that's only to be expected. From a financial stability perspective, Asset values are down, which in some sense lowers vulnerabilities. It's when they're really high that you would worry that they're vulnerable to a fall. Actually, many asset values have come down. I think you've got a well-capitalized banking system. I think you have households are generally in about as strong financial shape as they've been in a very long time, or perhaps ever, given what the money that's on people's balance sheets, and so you have from a financial stability standpoint, you have a pretty decent picture. Now, there are plenty of macroeconomic issues that don't rise to the level of financial stability concerns. By financial stability, we think of that as things that might undermine the working of the financial system. So big, serious things. That's not to say that people at the lower end of the income spectrum aren't suffering, because they are. They're suffering from high inflation. They're going to the grocery store and finding that in many cases their paycheck doesn't cover the food they're accustomed to buying. We're seeing actual real declines in food consumption, and it's very concerning. It's very unfortunate, and that's why we're really committed to bringing down inflation. One of the reasons.
Thank you, Mr. Chairman. Mark Hamrick with Bankrate. I can remember when you held your first news conference and you vowed to be a very plain-spoken chairman, and we're thinking today about the impacts of Fed policy on individuals as well. What would you say to individuals or households who may yet lose their jobs in this tightening cycle in the fight against inflation as they try to translate what Fed policy means to them in this complicated economic landscape?
Yeah.
Thank you.
So I guess the first thing I would say to every household is that we know that inflation is too high. We understand how painful it is, particularly for people who are living paycheck to paycheck and spend most of that paycheck on necessities such as food and gas and heating their homes and clothing and things like that. We do understand that those people suffer the most. Middle class and better off people have some resources where they can absorb these things, but many people don't have those resources. So, it is our job. It is our institutional role. We are assigned uniquely and unconditionally the obligation of providing price stability to the American people, and we're going to use our tools to do that. As I mentioned, there will be in all likelihood, some softening in labor market conditions. We need growth to slow to below potential growth. We don't want to, we don't want this to be bigger than it needs to be. But ultimately, if you think about the medium and longer term, price stability is the thing that makes the whole economy work. It's what can give us a strong labor market and wages that aren't being eaten up by high inflation. If you talk to people, again, people who are making wages, relatively low wages, they're the ones who are suffering the most from inflation. So it's all the more reason why we need to move on this. Thank you very much.
Righty ho. That was a longer one than usual. At least it felt longer. Did it just feel longer to me? I think it felt longer to most of us. Right, so what do we have actually here? Well, the market is celebrating. The market is doing, somersaults, all sorts of acrobatic things. Yeah, QQQ is up 4.3%. The S&P is up 2.76%. Coin, 12% up. PayPal, 12% up. Upstart, almost 10% up. Roku up almost 9%. Google up 8% in one day. Staggering stuff. Tesla up 6% to 823. Amazon up 5%. It's a good day to be invested. Hood up 4.9%. I mean, everything is basically flying. Is there anything that isn't? Let's have a look. Okay, Nano, whatever, NNBC, Visa down 0.5 point, Polestar down 0.5 point, and that's basically it. So pretty much the entire market is celebrating this news. Why? Because there is a market
also helps people understand how the economy works, so consumers have the tools to make sound financial decisions.
Language. Very, very significant difference.
Through this
acknowledge
education
the
program,
weakening
teachers have
economic
access to
situation.
classroom-ready online
acknowledge
resources for
that
students from
there
kindergarten
could
to
be
college.
downside
Videos,
risks to
classroom
hiking
lessons,
more
online
aggressively in
education,
September.
publications, and
He
more.
basically said
These
they are gonna
resources are all
basically,
free for
look at the
educators to
data
use
as
in
it
their
comes in.
lesson
That isn't a
plans or
surprise,
as they
but
see fit.
the language
Many of the
did
Federal Reserve
definitely
System's regional
change a
reserve
fair
banks,
bit. I hope
located
you,
in 12
find
districts
these
across the
little notes
nation,
useful. I know
also
the headline
offer
was a little bit
in-person
messy,
and
but it's sort of
online
the best way
professional
of doing it, so
development
I don't
that allows
interrupt
educators to
the first
deepen their
hand flow,
knowledge
and I
and
appreciate
hone their
you're here
craft when it comes to
listen
economics,
to Jay
personal
Powell,
finance, and more.
firsthand on your own. And
Students
yeah,
too
so we
can
are now
take
at
advantage of
basically neutral
in-person
in terms of interest
opportunities
rates.
by taking tours
We
of
are gonna get
exhibits
to, they
in
say,
many of the
3.25
12
to
Federal Reserve
3.5%
banks
by
around the
year end.
country. Whether a
And,
student visits with their family or a school group, they get
0.75%
an
hike
in-depth
could be
look at how the
appropriate.
Federal Reserve works
He's
to promote
being
a
a lot more
healthy,
cautious on guidance
sustainable
on the
U.S.
language here.
economy.
He wasn't as
At the
hawkish.
board and
He
reserve
wasn't
banks,
as, you know,
students also get
gung-ho about
hands-on
it. Somebody here
opportunities
throwing an
like
options trade, going
internships
to
and
straddle
participation
some
on
things,
student
hoping that the
boards,
market's
which
not
introduce
too
them to
volatile
key
for that
economics
spread.
concepts
Guys, you make a
and
lot more
potential
money. How much
careers
money
in
you making?
economics
Well,
and
look at that
finance.
here. We're at $1,232
Consumers are
today.
empowered
I've
to make
already taken
sound
about half
financial
of that in
decisions
profits.
through
I'll
the
probably take some
availability
of the
of
other
easy to
half
understand
later
resources
today.
that explain
But
personal
my
finance
co-trader, for
concepts,
example,
the
looks
broader
like it might
economy,
need
and the Federal
harvesting.
Reserve's role in
And
it.
this is despite
Federal
the
Reserve
market moving
education is
massively.
committed
Now,
to
Amazon
equipping
trade,
educators,
you might
educating
think we were
students,
bearish
and
on that. You
empowering
might think that's
consumers when
gonna
it comes to
lose us
understanding
money,
and
but look,
participating
we
in
could
our
go all the
evolving
way up to
economy.
$130.
For more
If not
information,
another
visit federalreserveeducation.org to
7-8%,
find
we're
links
still
to
making money
resources
here.
and reserve
So
bank programs
very, very
offered
high
near you.
probability trades,
And
that's
follow
what we
Federal Reserve
what we do. That's what
Education
we
on
teach. It's going
Twitter
up
at
127% so far for the
FedEconEd.
year. 28% up just in July so far, and these are real life gains. So there's a free course link down below. Do check it out.
What is the Fed?
Lawyer,
So what is the Fed?
What is the Fed?
What is the Fed?
The Federal Reserve, often referred to as the Fed, is the central bank of the United States.
Congress created the Fed in
We talked a little bit about
1913
insider
to help
trading rules.
promote
That
a
was a bit
safe
of a
and
silly
sound monetary
jab
and
at
financial
him.
system for our
He
nation.
did say labor market
The Fed
demand is
includes the Board of
slowing.
Governors
People
in
are not going back
Washington,
to
D.C.,
work.
which has
Not
7
surprising,
members,
really.
including the
Move on
chairman
to-
and vice chairman. All of the members of the
again, that's
board
the
are
first. He's
appointed by the
acknowledging
President
that
of the
labor
United
demand
States
is slowing
and
down. So
confirmed
that's
by the
definitely
United States
a
Senate.
good thing.
The Fed also includes 12 regional Federal Reserve banks
can't hear anything.
located in cities throughout the country.
The reserve banks serve as the central bank's operating arms and also gather
Really? You can't hear
economic
anything?
information from all over the country.
To help the Fed both monitor the economy and get the broad input necessary
video
to
is
develop
playing.
and implement effective.
Okay. All right. Sorry about that, guys. I appreciate it. I appreciate you still sticking around. So should I do a quick recap? I think let's do a quick recap. I muted the other yabberer now, and I'm yabbering just on my own. So I appreciate that. Okay, very, very quick recap here for everybody who's still around. Okay, essentially, we are at market neutral now for the interest rates. Now, they are going to go beyond neutral, so they are still going to go up probably another percentage point or so by the year end. Now, what he did acknowledge right off the bat is that the economy is showing some signs of weakening, that the labor market demand is weakening. And that's a big, big positive, a big juicy positive. And the market absolutely loves it. Hence this flying situation here. S&P Dow up 2.9%, QQQ up 4.74%, as is pretty much everything else. You just saw it. PayPal up 12.8%. I mean, who would have thought? Google up 8.4% and so on. Tesla up to $827. So that's all marvelous and staggering stuff. But he did really, in my view, change his language here. He wasn't as hawkish. He said there is a risk in doing too much. That's the first time I really heard him say that like that. We're getting a little bit more the kind of March Jay Powell, the more neutral, let's just wait and see kind of Jay Powell. And he said, yeah, we might get another 0.75% rate hike, but it isn't baked in. And as I said, he said that essentially we won't be changing the target for year end. So they're not raising where we need to get to. And let's have a quick look at the bond market, because that's always very, very important here. Americas, right? So bond yields tumbling, which makes sense. Are we still inverted? The 2-year is now still above the 10. The 5 is below the 30. Okay, that's good. So we're seeing nearer term yields tumbling more than the longer term ones. So we are moving back a little bit more towards equilibrium. At the moment, the market still very, very much prices in a recession. And now, can you make money in recessions? Heck yeah, we're up 1,175% just today. Already taken 1,200 now. I've already taken half of those profits, realized them. I might realize some of the other half. So you've got some really lovely trades here. That Pfizer trade doing really nicely, that MRK trade doing really nicely. Actually, all of them doing really nicely. Even that red Amazon trade there is actually looking really, really good. It's just time value here. And you can, of course, learn that if you're new to the community. Check out felixschwanzer.org/free options, a beautiful free program. Let me just see if I missed any questions here. Close the Fed website. I appreciate that. Thank you. Robert closed 13 trades today, each above 90% max profit. Well done, Robert. Brilliant. I am so, so happy for you. And really, it's your hard work. Robert is one of my most dedicated mentees, coaching students. You just knuckle down and go for it, and that's how you make money. So that's brilliant. I appreciate that. And yeah, there we go. I really appreciate you tuning in and watching here something firsthand. Very, very few people ever do that. Honestly, very few people ever do that. Most people rely on newspapers to tell them what's going on, which is usually, of course, complete gibber and nonsense. So you're doing something really marvelous by understanding firsthand what the people in power, so to speak, are saying. As I said, check out the link down below, felixschwanzer.org/free options. Take advantage of that. I put them out there so you become smarter, learn more, enjoy the green. Now, you do remember that last time we had such a green day at the Fed meeting, the next day the market tanked. I think today we actually have some reason to be green. I think the language has changed here. I think there is more caution, there is more acknowledgement of a weakening economy. So it's good. It's moving slowly in the right direction. Now let's go to the Hamptons and pummel them with champagne over the summer so they stay in a good mood when they come back in September, and make sure you don't spend too much money, because then you'll be driving up demand. We don't want that now, do we, as investors? I want to say a huge thank you for everybody who's tuned in. Appreciate it. If you haven't already, of course, destroy the subscribe and the like button. Join us. We do lots of coverage. I'm live 5 days a week, pre-market, and thank you very much for tuning in.